irrespective of where the market is it a good time to invest? When the market is down, they're very terrified. So the question is it a good time to invest? The sub-question hidden inside that is that will the market fall further? When the market goes up, is it a good time to invest? The sub-question hidden inside this, it's already gone up so much. Would I make a mistake jumping in now? So no matter where the market is, if it's not going up, you would see headlines in Economic Times saying gold has gone up 10% in the last 3 years. Stocks are down. So those things play on our mind and we say, is it a good time to invest? So no matter where the market is, if it's crashing, we are terrified. If it's sideways, we are not hopeful. If it's already gone up, again, we are terrified whether they're going to make a mistake or not. As I keep saying, we should avoid all of these issues because timing is not very important unless you really want that extra bit of returns. For an average person, it's fairly easy to choose to select a path which way to go, and we have sort of sharing this particular direction for a long time, for 5 years now, in different manner, different forms. I've been sort of explaining what is to be done. This presentation is quite interesting and quite new, and we are very happy to share this with you for the first time in Mumbai. We've done a version of this in Pune a few weeks ago, but I've improved quite a bit on that subsequently. I shared with you what investors normally ask, and this is what they normally do. Okay, here is a chart of Sensex. I'm going to share with you now a bar chart of mutual fund inflows. There's a very clear pattern over here. Anybody who's watching it very closely would know that I've already circled to. Anybody looking at this chart would know that the investors have participated the most at a previous market peak, which is over there. And then when the market started moving sideways, they have sort of got out in a hurry, or they have sort of kept on selling. What typically happens is that since bulk of the investments come in fairly late in the bull market, there's a lot of nervousness when the market falls, and then when the market starts rising, get me out at any price kind of a syndrome takes over. I've spent 4 years and I've got no return, so I want out right now. Once that happens and the market moves a little sideways, it's time for the cycle, the growth cycle to kick in, either investment cycle or a growth cycle or some good news. It's very simple, that you have a series of bad news and you're going to be followed with a series of good news. That's the way life is, and that's the way market is. So in this case, it was huge expectations. I'm not going into the details of whether those expectations are correct or incorrect, but huge expectations around the new government and the market sort of shooting up. In this case, once the market goes up, huge amount of investments started coming in. I read the other day in the paper that in the last few months, the investments that are coming into mutual funds in few months itself is equivalent to last 10 years of investments. I'm not sure if this figure is correct or not, but you can add up all the bars. It looks incredibly like a tide flowing into the market after the market has already gone up. There's a lot of explanations for this. There's a new class of investors I read in Economic Times who would not sure that they can buy stocks directly, which is a topic which is relevant to us. They lack skills, time, experience required for investing in shares. They want to rely on professional fund managers. All this is valid. This is valid at any time. But the question remains, what are they buying? Very interestingly, and this is a point that had become very important in the US many years ago, and this is going to happen in India too. The number of equity mutual funds are 352 already, and they'll keep increasing. Because it's very easy to launch a new fund, especially very tempting to launch a new fund when the market has gone up, because people want to invest in, for 10 rupees in a new fund, irrespective of whether the underlying shares have gone up or not. So a lot of closed-ended funds came up, and a lot of new NFOs have started coming to the market right now. So you can very well be certain that this 352 is slowly going to inch up to 400, 450, 500. In the US, the number of funds are more than the number of stocks. And we've already reached a situation where the number of funds are more than good quality stocks, at least. There are 6,000 stocks listed, but who cares about 6,000 stocks? A majority of them do not earn a return on its shareholders' capital that would justify our investment in them. So if the bank is lending to businesses at 12%, 30%, or 14%, if a company is not able to earn more than that, it is doing a very poor job. And companies that are earning more than 12, 13% are very few in number. They're not more than 200. I've extended my list to 11%, and I get a figure of 350 stocks or so. Let's say 300 quality stocks and 352 mutual funds. The question and the problem and the issue remains, how would you choose? In principle, there's no difference between stocks and funds. A lot of people try to tell you go by the fund route if you don't understand stocks, which is okay, fine, which is absolutely valid. But I've already posed the first question. If you can't choose stocks, how would you choose funds? And vice versa. But some amount of technical knowledge is definitely needed. It's not so easy. Both are volatile on a day-to-day basis. The reason we get to know and discuss more about stocks is because stocks, there is a ticker for stocks. There is no up, down, minute to minute, 5% up, 3% down kind of thing on NAV. NAV is calculated at the end of the day. You don't even get intraday NAV. I mean, you can calculate if you want to, but it's madness for any mutual fund investors to even ask to calculate intraday NAV. Whereas stocks are being discussed every second, and there is a ticker, as I said, which keeps running. So we get to feel as if the stocks are much more volatile and mutual funds are much more safe. They are not. Now, both fall. When they fall, both fall very sharply. And I just happen to sort of ask these questions, and I come up with a very interesting answer. Here is a chart of a fund or a stock, and the next chart also of a fund or a stock. We don't know which is which. They all both look similar, isn't it? In fact, the first one looks more like the stock, and it isn't. That's HDFC Top 200, and the second one is a blue chip company of India, which is Infosys. Forget about which has gone up more or less or whatever, but they look very, very similar. When they fell, they both fell. When they went up, they both fairly went up in tandem. Funds are wonderful products, and there are lots of interesting features in funds which we cannot ignore, and which is very, very important for an investor who is possibly investing for the first time, investing less, and so on. And here are the reasons. You have absolutely no time to even look at stocks. Very often it happens that we get a email from somebody who is 60, right? Moneylife Foundation member or magazine reader or whatever. 60, 65, 70. Not only is he managing his own money, but he's managing the money of his son or a daughter as well. And they're so busy, they don't even know where the money is. They just are interested in earning and possibly spending and partying. So in a situation like this, where you have absolutely no time at all, which is what is happening to a lot of young people, funds are the right route. No interest. I completely sympathize with this. There are 20,000 more interesting things in the world rather than figuring out NAV and return on equity and company management. Finance is boring. There's a reason why it's boring. It's sort of the best of finance is unexciting, and people want some change every day and so on and so forth. No one to trust. The other day there was a lady in our seminar, and she kept on repeating, wonderful presentation, great, but I don't know whom to trust, after having come to Moneylife Foundation. So I said, you won't like the answer I give, so I won't give that answer. Sure, I sympathize with this. 50 people may be trusting me, but what about the 5 lakh people who are outside? They don't even maybe know about me, or they can't attend a conference seminar like this. And if you've gone through one cycle, which is where you invested in 2007 and you sold at 2010, having got disgusted with negative returns, that is losses, being nicely put, or meager profits, you don't even trust yourself that nobody would believe that, nobody would admit that, but in a heart of hearts you feel that, I don't know, this is not for me. And this is a very important point. For an average person may just not have the money to invest in stocks. And this is most often, this is something that is not highlighted by the media. It's a very, very practical and important issue. To invest seriously in stocks, you need to sort of diversify a bit. Say you need to invest in about 10 or 15 stocks. May not be at the right time, but fairly closely to each other. If you stay exposed to one stock, you're taking a huge risk. If something goes wrong with that company management, or the external environment, or something in that sector, it's not done. It's a very foolish thing to do, just to buy one stock. You buy 10 stocks. Today, all high quality stocks are in 4 digits. Whether it's HCL, or whether it's Infosys, or whether it's TCS, MRF is some 36,000 rupees or so. It's a very good quality stocks. He refuses to either split or give bonus, and he's been like this for the last 25 years. I know, Mr. Mapillai. And so the stock is valued at 36,000. If you buy one stock, you need 36,000 rupees. And that's an extreme example, but any good quality stock, Nestle is 6,000 rupees, for instance. This problem is just going to get worse and worse and worse, because India has this funny concept of par value. It has to be at least 1 rupee. So you issue a bonus and you do a split, and it becomes 2 rupees, and then it becomes 1 rupees. Good quality companies keep growing. When they grow, they earn more net profits. When they earn more net profits, the share price goes up. So 1 rupee stock can become 6,000 rupees someday. What happens then? 6,000 can't be, you can issue another bonus maybe, but you can't split the stock anymore. So at some day, Indian government will have to think in terms of not having a par value, but that's for them to decide. But net problem is that if you want to buy 10 stocks, you need 50,000 rupees maybe, or 40,000 rupees to start with, if you have to diversify and buy quality stocks. And in a situation like this, a lot of people look around for, double-digit stocks and stuff like that. And that's risky, because you're not focused on quality, you're focused on the number. So for all of these reasons, including the fact that it's your first day investing and you don't want to take a chance, or first year in investing, mutual funds are absolutely fantastic, wonderful. I'm all in favor of them.